Ladies and gentlemen, welcome to the Fiscal Philosophy YouTube channel. Today's video is, of course, about Google. This is a stock that, of course, I really like a lot. I believe that amongst Magnificent Seven stocks, Google and Amazon are the most compelling long-term holds and most compelling value propositions at this moment. It varies day to day on which one might be the better value proposition just based on where their price is at any given point in time. If one is, say, down a lot and the other is up a lot, it could affect which one is at that present moment the best value. But Google is the primary topic of today's video. They reported earnings a few days ago, and after hours it popped off a bit, but it's kind of cooled off since then. And what we're looking at right now is pretty undemanding multiples for a company with Google's moat and revenue growth and future potential. Analysts still kind of like it, but don't maybe necessarily love it. I'll get into the numbers in a little bit and tell you where I'm landing on this at the moment. All right, so jumping into some highlights on the numbers from their most recent earnings, I just want to take a quick moment to just kind of bask in the glow of how amazing it is that a company this size, compared to the comparable quarter last year, can still put up a double-digit revenue jump. That is massive, okay? And that is what tells me that this stock may be a bit underrated, okay? People are expressing this narrative that they're dead, that LLMs are eating their lunch, etc., etc., and they were so sure we were going to see it on these Q1 numbers. And so far, I mean, I don't see a dying business at all here. Next, we go down to the bottom line, which speaks the loudest in this. Net income jumped nearly 50%, as did diluted earnings per share. That's amazing. And that's the result of what happens when you drive up revenue in a company that has high margins. And Google, being what they are, tends to have very high margins in a lot of their business segments. And so a jump in revenue correlates to an extremely large jump in that bottom line if their expenses grow more slowly than their revenue does. And so here we go. This is pretty impressive stuff, to be honest with you. And without delaying it too much, I want to just address the elephant in the room, which is the LLM destroying Google search narrative that's been out there. It's going to melt it like an ice cube in a blast furnace, is what I've been hearing all over platforms like X, where all the true investing geniuses bloviate, of course. So here we have the Google Search and Other segment, which reports under this services kind of umbrella here, but they break it down more. You have a 10% year-over-year growth in Search and Other. Now, I have to imagine, since they're calling it Search and Other rather than the other way around, that Search is probably the vast majority of that revenue. And that segment had a 10% revenue growth in Q1 of this year compared to Q1 of last year. So that to me doesn't spell doom and gloom for search. And even on the earnings call, they went over this for a bit. I can't remember if it was an analyst question or if it was just in their remarks, but they basically said that what they think they're seeing in like reality in the majority of cases is that LLMs like ChatGPT or anything similar, heck, Grok if you're a Twitter fanboy, it seems to be for most instances, it's like a different use case where you're not really using those two things for the same thing. So granted, like, yeah, you hear the random people, the random Google bears out there saying, I never use search anymore. I only use ChatGPT. I only use this. I only use that. Okay. All right. There were people who used Bing and DuckDuckGo as well, but I don't think that's the vast majority. So I don't really buy that narrative because I just don't see it reflected in any of the hard data that we have available. The next I think big thing is Google Cloud and where that's going and how that's been doing. All right. So I don't know what people were expecting on this, but what I'm seeing here is 28% revenue growth compared to the comparable quarter of last year, and an almost doubling in the operating margin, which tells me that as they grow the revenue here, it seems like they're getting more operationally efficient, which means more profitable as it gets bigger. And it's getting bigger. So I like this. I think, if anything, that this is going to be very accretive in the next few years. They don't have to keep this up for very long for this to be heavily, heavily profitable for their shareholders. And I personally love to see it. And I think that this is overall definitely a home run. I don't know if you'd call it a grand slam, but I think they're doing quite well here. It seems that there is room in the market for Google and Amazon and Microsoft to all be in this space, at least for now. It doesn't seem to be too crowded for them to be able to grow and grow profitably, which that's the key thing, grow profitably. So I'm excited for the future on this. And so far, I think they're doing a pretty good job. One possible drawback to all of this growth, of course, is that it does take an initial investment in CapEx in order to build out that infrastructure they need to build out all of these different innovations and business segments. So the cloud computing that they do, they have to buy, data centers and servers and all kinds of stuff. And that stuff does not come cheap, okay? So yes, $17 billion in Q1 of this year, a big jump over Q1 of last year, and even sequentially versus Q4 of last year. Like a pretty honkin' big jump. However, I think if their revenues and operating margins and things like that are going up in these business segments, that it's sort of safe to say that they're probably using this CapEx money wisely, and they're using it to drive innovation and growth and infrastructure that they need to stay competitive in this market. And as long as they can grow these business segments in a profitable way, I'm not against them continuing to make these investments, because that's really what capital expenditures are. They're investments in the future of your business. And if you have a good business that has a future in front of it, then the CapEx spend is not something to necessarily balk at. So I'm okay with this because it seems like the proof is in the pudding. Profits are going up and revenues are going up. So they are indeed utilizing this money in a way that seems to make some sense, at least from my perspective. The other thing I want to do as kind of a counterpoint to the CapEx situation is point out that free cash flow is still very healthy, okay? So compared to the comparable quarter of last year, free cash flow is still actually up. Now, it's not up sequentially compared to Q4 of last year, but I think Q4 tends to be pretty strong, as you do have like the holiday season and such, which ad spend kind of goes up. You also had last year's Q4 being an election, a very big election. So elections and holidays tend to increase the ad spend, and of course ads are one of the biggest drivers of revenue and cash flow for Google. So it makes sense Q4 would be dramatically high in a year like 2024. But if we compare apples to apples, Q1 of 24 to Q1 25, free cash flow up in spite of the fact that CapEx went way up. So I think this is encouraging to see. They're not anywhere near driving their free cash flow down or negative in any kind of way. So if they're still producing a healthy amount of free cash flow in spite of all the CapEx, I'm not going to complain too much about the CapEx. And hey, at a certain point, when the growth in cloud and such starts to slow down, they may slow down and drop the CapEx to a certain extent, which guess what happens then? Free cash flow goes way up. So still, these are all reasons to be excited about the future. Another thing I want to point out is that while this company is trading at like somewhere between like a 17 and 18 price to earnings, they're also at the same time growing substantially and consistently buying back shares. Okay. So looks like the trailing 12 months, they bought back about 2% of the company. Now, the dividend is not super substantial, but this is resulting in a total shareholder yield of 2.5%. And again, the buyback is especially accretive because if they're growing at the rate they're growing and the multiple is staying cheap, they're actually very, very effective at using their capital at these levels on buybacks. This is sort of what I think made Apple so compelling for so long to so many people is there's just the consistent buybacks with the abundant amount of cash they were producing. Now, if their stock suddenly went through the roof and they were trading at like a 30 PE or something, I probably wouldn't want them to do too many buybacks at that point, because like I don't think that's necessarily a very cheap price, and I think they could probably get more value for shareholders somewhere else than buybacks at that level. But still, at these levels, with the growth that they're still producing, I think their stock is definitely on the cheap side. So these buybacks are very nice with that in perspective. Please feel free to comment below with your thoughts on Google and their earnings and their viability as an investment. Please feel free to join Discord, linked in the description. It's free. Don't charge you anything for it. You can follow me on the X platform at Mr. Macho Mog. Also, feel free to check out the channel's sponsor, Moomoo, and if you sign up using my link below, you can get some free stocks just for signing up and depositing and trying out the platform. They have many different trading indicators and all kinds of fun stuff. Let me know any thoughts, like, subscribe for the algorithm. Take it easy, everyone.